So continuing to preview today's FOMC meeting, let's welcome in Yahoo Finance's Myles Udland. Myles?
Hello.
What we're looking here, it's good to see you. All right, so 75 basis points is what we're looking for. We've heard from some of our guest calls for 400 basis points. Where do you believe that for the Fed that they can get their credibility right?
Yeah, I mean, I was talking a lot about this with Brian Chung, and I think he and I, it's not that we differ, but that I maybe come in a little bit hotter, because I think the Fed is about to make a huge mistake today, and I think the reason is sort of how do you get out of this conundrum now? Like, what's the next move? Okay, so 75, then 75, but what are how are we going to forward guide to September? What about November? How are we to get the markets to believe that we, as the Fed, will slow down our pace of rate hikes when we decide to do that? And there is another possibility here that with this buzz around 75, they've actually made 50 like a more potent rate hike, if that makes sense. So it wasn't just a pro forma 50-50. Now 50 becomes a surprise. And we can see here 95% pricing for 75. So I guess 50 is off the table. But to me, if I'm sitting in that meeting today and I'm a dove on the Fed, or just I just want to keep with the forward guidance, maybe 50 matters a little bit more, given sort of what the last 72 hours have looked like.
Why not 100 basis points? And we put that question to Dennis DeButcher, and he said, be careful what you wish for. What's your take on that?
I think the 100 basis point talk, I mean, I think like after Friday's data, it became clear to me that there was going to be a real conversation now around where we needed to go. And that really coalesced over the weekend, and pretty much everyone's gotten in line with that. Like the 100 basis points, especially you look at Bill Ackman out last night, some of that to me rings of like, all my stocks are down. Can we kick save this a little bit?
Looking for 3%?
Well, because the second part of his thing is we need to do 100 now because we need to get to the terminal rate now so that we can cut later, which is like, I'm long a bunch of stuff that's not going to go up until rates start coming down. So please get to the top of the cycle as fast as possible so that my stocks, and look, that's like most people on Wall Street who are managing money are getting destroyed right now. And they do want the cycle to turn. But Jay Powell just does not care. Like, I think he's looking at what's happening in real estate. Obviously, it's a main transmission mechanism, but they probably look at total crypto market cap going from 3 trillion to 1 trillion or under, and they're like, that's great. You know, that's like fake money, fake wealth, paper wealth that is being sucked out of the system, and that has real impacts on real spending in the economy.
And I'm sort of taking a step back and taking like a super long view. This is something I was thinking about yesterday, is that even if you look ahead to the recession, yes, there's going to be damage. There's going to be people who lose their jobs. There's going to be stuff that's cut. There's going to be economic turmoil. These things don't tend to last that long, if I can say that. And it doesn't feel like a coming recession would be as bad as, say, the great financial crisis, right? Like, at least, and I was thinking about covering also the financial crisis versus covering what we're going through now. Mm-hmm. And that was like, every day was an explosion. Like every day there was an alarming headline,
Stocks
and it was like
60% out of the
it was
blue.
like triage every single day. This is sort of this slow run up. We can all see it coming. And I also was looking at the S&P 500 returns, a little bit inspired by the likes of you and Sam Rowe. And if you look at the long-term returns, of course, like bear markets also don't last that long.
So I hear what you're saying, and I like the reason that I tend to push against that kind of worldview of like we should just get the recession over with or get the bear market over with is that we can sit here now in June 2022 and say, oh, well, we know this recession probably won't be as bad, or we know it's caused for these reasons. But in downturns, bad things happen that we don't know about. In the same way, that in, up cycles, I mean, look, 13, 14, 15, 14, 15 to oil. Like, let's go 12, 13, 14, looking at the market. Why did stocks go up? Earnings started getting better. The economy started repairing itself. Corporate America started first. But that led to all these things we didn't think about. A crypto bubble then emerged, and a VC bubble emerges, and now the heat's coming off that stuff. So up and down have their negative externalities, as folks would say. But to me, the externalities on the downside are always worse, and they are to be avoided. Now, they probably can't be avoided, but I don't feel resigned. Like, I don't feel happy about this.
No, I don't.
I don't think you do either.
And I'm not saying that we should rush through. What I'm rather saying is that while Bill Ackman might be feeling a lot of pain in his portfolio, if I'm not retiring until 10 years from now, like, I don't need to be hiding in a, under my bed somewhere. Like,
yeah. I mean, I know what you're saying. I think a lot of this also, and I know we got to move on, but a lot of this gets to like an idea that I've been thinking about a lot, which is that flat for everything, stocks, housing, crypto, commodities, like flat for the next 5, 7, 10 years, That probably frustrates the most people. And so I'm kind of getting like, maybe we just go between 3,000 and 4,000 in the S&P for a really long time.
Maybe.
It's just
Any
an
story
idea.
to plug while we have you? Anything on the homepage? Anything? No?
No, I mean, we got...
We're out of time here, Cy.
I know, we got, we'll get into that.
Just come to yahoofinance.com. All right, thank you so much, Myles.